Mutual fund managers versus retail investors. Key differences in stock investing strategies for long-term success. GETMONEYRICH. Practicing long-term investing in stocks can be challenging. This is especially true for retail investors who often look to experts for guidance. For example, when a certain sector or theme like defense, PSUs, capital expenditure, infrastructure, etc. are doing well, they will recommend the same. What is the point of repeating these names on TV channels when their valuations already look expensive? They also do not mind recommending low-margin businesses like telecom, airlines, etc., which are also extremely competitive and heavily regulated. As a long-term investor, I will avoid adding such stocks to my portfolio in normal times. Unless these stock prices crash by 30% or more, I will avoid fresh additions of such stocks to my portfolio. 1. Investment goals and objectives. 2. Profit booking, mutual funds versus individual long-term investors. 3. Investing in underperforming sectors, mutual fund managers versus retail investors. 4. A hypothetical example. 5. Data supporting the argument. Not all stocks in the portfolio of a mutual fund scheme are bought with a long-term perspective. The core holdings of an equity mutual fund are typically selected for long-term growth. This aspect of their portfolio suits long-term growth. However, the fund managers may also include a few stocks as shorter-term tactical opportunities, momentum plays, or sector rotations. This mix allows fund managers to capitalize on market trends and also enhance the overall returns of the portfolio. Retail investors will not know which stocks in the fund's portfolio are held for the long term and which are short-term tactical bets. Mutual funds tend to buy quite a few stocks with a short-term perspective, typically with a 6-month to 1-year horizon. These stocks are picked when they display a strong current price momentum. Representatives of fund houses come on news channels to promote such stocks on TV. This way they further drive up their demand, subsequently inflating their P ratios. Unfortunately, retail investors who follow these recommendations might find themselves buying at inflated prices. Investment goals and objectives. When a retail investor is investing with a long-term horizon in mind, she is actually doing it for wealth building. This activity of stock investing is a personal act of trying to achieve the ultimate goal of financial independence. 1.1 The focus. So you can see the difference in the focus between an individual investor and the fund house. The former does it for personal wealth generation and the latter is doing his job to generate the alpha. A mutual fund might do a few things differently from an individual to get that alpha for its portfolio. Because the NAV of the portfolio is reported every day. The NAV of the mutual fund is not just a pricing tool of the mutual fund schemes, the growth rate is also used as a marketing tool. If the NAV of a mutual fund scheme is growing even at a fraction of basis points higher than its peers, it will make a lot of difference. 1.2 The confusion. Most retail investors are practicing stock investing with no goals in mind. They are there to make money. For them, stock investing is yet another way to make money. But it is not the right approach. Stock investing can build wealth only by staying invested for the long term. Even experts promote stock investing as a way to achieve personal goals, such as saving for retirement, funding a child's education, buying a house, car, etc. Till the goals are 7-10 years ahead in the future, there are no problems, but for goals that are due in the next 3-4 years, stocks are not suitable. Profit booking. Mutual funds versus individual long-term investors. Here we'll explore how profit booking practices differ between mutual fund managers and individual long-term investors. I'll try to highlight the regulatory and strategic constraints that limit mutual funds' long-term returns. 2.1 Mutual funds profit booking practices. Pure equity mutual fund schemes operate under specific regulatory and strategic constraints. They must balance long-term growth and short-term performance. For example, they may invest in stable, long-term stocks like TCS and Reliance for growth, while also buying high-momentum stocks from defense or PSU space for short-term gains to attract and retain investors. Key factors influencing profit booking by mutual funds: regulatory requirements and compliance. Mutual funds must adhere to regulatory guidelines set by SEBI. Liquidity needs. Mutual funds need to maintain a certain level of liquidity to handle redemption requests from investors. Performance metrics. Mutual fund performance is often evaluated on a quarterly or annual basis. Market sentiment and tactical decisions. Fund managers may also engage in tactical profit booking based on market sentiment, economic forecasts, or sector rotations. 2.2 Individual long-term investors' profit booking practices. Advantages of individual investors. No mandatory rebalancing. Individual investors are not required to rebalance their portfolios based on regulatory guidelines. Long-term focus. Unlike mutual fund managers who may need to demonstrate short-term performance, individual investors can focus purely on long-term gains. Flexibility in decision-making. Individual investors can make profit-booking decisions based solely on their analysis of a stock's valuation, such as when they perceive the price-to-earnings (P) ratio to be excessively high. No redemption pressure. Without the need to accommodate investor redemptions, individual investors can remain fully invested in their chosen stocks. This lack of liquidity pressure means they can ride out market downturns and wait for the market to recover, capturing the full growth potential of their investments.